Hi, everyone. Welcome to This Week in Crypto. It's not what the podcast is called, but it could have been.
Welcome to the DeFi podcast, where we attempt to imagine the future of crypto because foresight is what makes great investors. This podcast is for informational purposes only and should not be relied upon as a basis for investment. All statements made by hosts or guests are strictly beliefs or point of views and are not recommendations to buy, sell, or hold any security. Hosts or guests may hold certain securities discussed in this podcast.
So this week we're going to talk about stablecoins, which seems like a dry topic, but it is actually incredibly important. I think we saw the importance of this over the past couple of weeks with the Terra crash. If you're a novice crypto investor, you need to understand the basics that we're going to cover. And if you're advanced, there's some details that you may or may not be super familiar with. So this is going to be a great review for everyone. So there are three types of stablecoins. There's the dollar-backed stablecoin, or the so-called dollar-backed stablecoins, the pure Algo stablecoins, and the over-collateralized stablecoins. Jared, which of these stablecoins do you like, and which of these stablecoins do you thoroughly dislike?
I'm beginning to not really like any of them, to be fully honest with you. But I would say if I had to choose, the kind of on-chain crypto-backed stablecoins, to me, are becoming apparent that they're kind of the only real solution. The other two just have too many problems.
Right. So let's take them one by one. Let's start with the dollar-backed stablecoin. We had a whole show on this, so we're not going to spend 20 minutes on it. But what are the issues there?
Just the fact that they're not very clear with what is exactly backing the full circulating supply of these stablecoins. You know, they have some numbers here and there about like what makes up what percentage of their backing, but essentially it's not 100% US dollars to 100% of these tokens. You know, it's not a 1-to-1 ratio. And even where they claim to have US dollars, it's not even totally sure that they're actually hard cash, you know, in the bank. And they do have some percentage of potentially like volatile assets. So it seems to me like that's a pretty big problem, especially in the current economic situation. I would have a lot of questions raised about these kinds of things.
Yeah, if you're buying into a dollar-backed stablecoin, you want it to be dollar-backed. It's sort of funny that that's not inherently what is backing these stables. And the assets backing these stables may be safe or may not, because we don't actually know necessarily exactly what they are. We know what the claims are, but we can't directly verify like something that is on-chain. So some of these stablecoins have large market caps and are managed in a very opaque manner.
Yeah, you can't really know what's going on for sure. And even where they try to claim that they have some kind of, you know, transparency, you look at the actual reports that they put out, and it's like a paper saying, we verify that this is true, but it's coming from themselves.
Or from an accounting agency that's external, but that has clearly like, I mean, obviously they want to report what the company paying them wants them to report. So there's probably a conflict of interest there. But yeah, it seems a little convoluted for what we're trying to achieve, which is transparency and which is just having a dollar on chain, right? So the second option of stablecoin is the pure Algo stablecoin. And as we've seen with Iron Bank and as we've seen with Terra, these are not recommended at the moment.
Well, you know, it's really interesting to see that Luna 2.0 is coming out. And I heard somebody saying that Luna 2 is very much like Luna 1, except it's even better at going to zero.
It's pretty good. Poor Luna. Poor Luna holders. Yeah.
So, yeah, I mean, at this point, I think we've just seen too many fails with Algo stables. There's too many risk factors and all these different things that they try to do to keep them in place. And ultimately, at the end of the day, the only thing that ensures that these things don't go from, 100 to 0 overnight is what is the current hype around them. If people believe that they're worth something, they're going to be worth something. But if it starts to slip, people are going to get out and then they're going to go to 0.
Right. So having the balancing asset tied to the pegged asset, I think, is where the fault lies. Because you can attack one and you can have an incentive to attack it because you can short some of these assets. And,
Yep.
because they're tied together, they could both go to zero at the same time. They can both deflate as everyone is trying to get out of one to get into the other, but then they're trying to get out of that one. And then it is why we call it the death spiral, because it's back and forth until we hit the number zero.
Well, I think at this point there's something like trillions of Luna in circulation, just because of the amount of people who took UST, minted Luna, and sold it.
Right. So let's talk about over-collateralized stablecoins and why we like those.
If you think about it, we're using crypto-backed. It doesn't matter what you're basing it on. The point is that the value of the token that you're using to mint one of these stable coins has its own value that you can trade on, and it is over collateralized. It based on the specific protocol, it must have more collateral than the value of the token. So even if one of your peg or your collateral starts to devalue or something, you can either have some liquidations or some kind of scheme to ensure either side of that situation is kind of upholding that peg and keeping it stable, actually stable.
Okay, so how does this process work? Let's explain it. So we're going to use Moremoney because I'm part of that team. So I obviously am familiar with the protocol. So let's say you come to Moremoney, where you can deposit a number of different collaterals. We have about, I think, 11 active collaterals. You're going to have a lot more in the future. Our goal is to accept a wide variety of different collaterals. And you're coming to the platform to mint or borrow $100 of money. We are going to ask that you deposit an amount that is higher than that $100. It will be different for different assets. And if the underlying asset that you deposit varies in price and goes lower than a certain predetermined amount, which is going to have a safety ratio. So it's never going to be $100, right? It's going to be something like $120. So if you ever hit $120 with your asset, what we're going to do is we are going to close out that loan and we're going to take money out of the market. So in that sense, money will always be over collateralized.
So if somebody has a loan and they have collateral on one side and they have money on the other side, if they get liquidated, they still have that money in circulation, right? So what happens if you still have this extra money that they've borrowed and now you're taking the other side in order to liquidate because the collateral has devalued?
Right. So they still have the outstanding amount that they got in the loan, right? But what we're going to do is we're going to take their underlying collateral. We are going to liquidate it. So essentially, it's going to be sold on the market, and someone's going to make a fee to provide the service. Then we're going to take the amount there, and we are going to buy money and take money out of the market.
So can we actually see an over-collateralized stablecoin DPEG? And how would that happen?
So once you have minted your stablecoin, so let's say you've minted money, you need to be able to trade in and out of that money, right? So it's going to be trading on a liquidity pool. In our heads, let's create a theoretical pool where there is USDC and money. They could do a money AVAX pool. It doesn't really matter. We're just going to use money USDC. So in this pool, starts off 50% USDC, 50% money. And people are borrowing. They're going into the pool. They're depositing that initial $100 of money, and they are taking out $100 of USDC. So this pool, depending on the total amount of collateral, is still going to be healthy after that $100 change. It's not trading like typical swap pools where the algo running the pool is sort of like as soon as you lose a little bit of supply, the price changes. So the price is going to maintain pretty far out, right? So you could have 20% of one asset and 80% of another asset in the pool, and the peg may be very close to one-to-one still. But at some point, this pool is going to have to defend itself and say, "Hey, we're going to give you a deal if you take the asset that we have too much of," right? So this could affect the peg negatively. So, for example, if everyone was minting money, putting in this pool, pulling out USDC, USDC would be going close to zero, and money would be getting close to 100%. So the value of USDC in this pool relative to money would go up because the pool has to defend itself. So that's how you would have a coin that is over-collateralized, typically DPEG.
Okay, so DPEG could happen if basically your pool just gets heavily imbalanced because you have so many people opening up positions that they're filling up the pool with money because they want to take out USDC or they want to do something else with it.
Right. It could happen in the inverse as well, right? But yes, in this example, that's the way we're doing it.
What mechanism would you put in place to prevent this lopsided pool from hurting your peg?
So there's essentially two types of popular mechanisms that you can use to do this. The first one is having a variable interest rate, which is going to make it more or less popular to borrow when the peg is affected. So, for example, if you're starting to see too much money in that liquidity pool, it means that it's too attractive to borrow. Therefore, the interest rate could move up, making it less interesting to borrow, and you're going to see the pool get more in balance. And depending on how you set up your variable interest rate, you could do it very, very stringent, and it could, most likely completely solve your problem, right? So that's the first option. So the second mechanism, which is quite robust but not extremely friendly to people borrowing on the platform, is called forced redemptions. In which scenario you're going to, when you see that there is too much money in the pool because there's been too much borrowing, you are going to take the people who, generally speaking, the way this is done is the people who are closer to liquidation. You're going to take their positions and you're going to close out their loans. So it's sort of an early, it's sort of like an early liquidation, and it's going to close out the underlying collateral. You're going to go onto the market, you're going to buy money, you're going to run it through that pool, and you're going to close out those loans. You're going to rebalance the pool in that process, because you're going to be using the underlying collateral to go to USDC, take that USDC, buy money, get it out of that pool to close out the loan. Now the pool has more USDC in it.
I hate this as an option.
So yeah, it's not a super friendly process. Users don't want to have their loans redeemed. When you take out a loan, you have a plan for it. You have something in mind. So you're not going to be left off worse than your actual position. The protocol is not going to take your money and go out and spend it. They're just going to close out the loan, the portion of the loan, right? So they're not going to take more than what they need to close out your loan, right? So you're going to be left off in the same position. That's important to understand. But it may screw up your investment. You may not notice this happen if you're not watching the protocol, and then you may come back to a position that has been liquidated, and now you have this other position that you borrowed. So you're left off in the same position, but it will change your strategy, which is very unfriendly. So we agree with that. But it is very robust. So it is an important card to have. It's something that every over-collateralized protocol, in my opinion, should have the capacity to do, because saving the peg and keeping the peg in line is the most important goal of having a stablecoin. It's called a stablecoin. It needs to be stable. If we want to be serious in crypto and call something by a certain name and then have that name adhere to what its dictionary definition is, we need to actually be serious about doing serious things. So there's been some stablecoins in the past that I've built their model around forced redemptions. For example, Liquidity, and for example, Moremoney Finance. So we have this capacity, but we realize that it's not a friendly idea. So on top of this capacity, we're now going to be adding a variable interest rate model, and that's going to be the first line of defense to keep the peg in line, which by itself may not be enough in all situations, but will definitely be enough in the large majority of instances. Therefore, forced redemptions should, become a thing of the past, at least for more money. But in the case that a pool gets super out of balance, we will still have that capacity, which means that we'll always essentially have a very, very strong peg.
What do you think is the benefit of having the variable interest rate model compared to the 0% interest rate? Because I think that actually sets the money token apart from a lot of other stablecoins when you can have a 0% interest rate?
Right. So I would say two things. So if you're doing the 0% interest rate token, your the only way to defend the peg in a robust manner is going to be to force redemption. So if you don't like forced redemptions, you can't have 0% interest rate. You must move to an interest rate model. And I know you, Jared, personally do not like forced redemptions. You're very against it. So if you're very against this, you should like having some interest, which will be very low when the peg is in good shape on money, which is most of the time, by the way, because we've been, it's been a very stable coin, right? So we're just going out of our way to make it ultra sound and to increase the user experience by not having to force redeem people. So we're going to have a very low interest rate when the peg is healthy, which is most of the time. We're going to have a lower minting fee, so people are going to be able to come in and out of money on a short-term basis. And the other advantage is that this interest rate is going to be streamed to people who take money and stake it. So this is going to create a use case for money. Now people are going to go into the market and just hold it because you can get an interest rate. It is going to be the first interest-bearing stablecoin on Avalanche, which is a major step forward for money and for Avalanche. There's, every time you make a strategic decision, or almost every time, there's, generally a trade-off. And there is a trade-off here, of course. But I think the trade-offs are much more enticing than the previous situation.
Right. So the other thing that I would have concerns about is the forced redemption situation. Instituting a policy of forced redemptions being on the table could potentially lead to people being punished for having a high level of capital efficiency, let's say.
What you're saying is that if they're very close to the loan to value or to the liquidation ratio.
Right, but if they're keeping that in there on purpose, let's say that you're actively managing it on a day-to-day basis, could actually mess up your position if you get forced redeemed.
Right. So I agree with you, which is why you should be putting all of your money in money, because we're going to have the variable interest rate sort of manage that risk for you, and it's very unlikely that we're going to use forced redemptions. Okay, so to wrap it up, money is going to have, yes, it's over-collateralized, but then it has two defenses for protecting the liquidity pool. We have the forced redemption model, and we have the variable interest rate model. I can't actually think of another stablecoin that has both. Usually a stablecoin will have one or the other. So this is why we think about money as sort of the ultra stable stablecoin. It's going to be around. I think I have a high conviction level that this is going to make it. We've held really great peg up to now, and now we're going to have a whole other layer of defenses to uphold our peg. We're also going to be the first native interest-bearing stablecoin on Avalanche, which is a big deal. And this is not Luna-type interest that is either coming from VCs or coming out of thin air. This is actually sound because it's coming from a borrower to a staker, which is the way that things work in the real world, which is the way that things should work in crypto. If you're receiving interest or if you're receiving emissions, or rewards, they should be coming from someone else. They shouldn't just be, minted. I think a lot of very, very positive, exciting stuff coming for money.
Well, you said it's kind of like in the real world. I think it's actually, I think it's better than the real world because, you can just imagine probably most people in crypto are looking at, the US dollar, for example, just losing its value, and you see inflation, and you think, most people who are in crypto can see that, these things are not just endlessly inflationary. You have the essence of like a real valuable thing that does something. Even in the situation right now where prices are tanking, it's still worth something. You can still trade it for something. And I think long term, those values are going to hold strong and continue to increase.
Yeah, that's a good point. And governments are incompetent. They're essentially large bodies, large committees without accountability, and they have proven themselves to not be I think, responsible enough to manage money. So hopefully crypto will be a saving grace to the way we trade as human beings. I think a lot of human progress depends on decentralizing these incompetent committees.
I mean, just Bitcoin's getting a bit old, but still, Bitcoin still has some value. There's still something there that you can see. It's a good idea. I think the more we get into Avalanche and over-collateralized stablecoins and such, we're just refining good ideas on top of even better ideas.
Yeah, absolutely. Okay, so if you've been watching this far, thank you. Please follow us. Sorry if this felt like an advertisement for Moremoney. This is not the point of this podcast. But I think we're doing a lot of interesting stuff, and it's what we should be talking about right now. It's the different models of stablecoins, what works, what doesn't, and where we need to sort of take things in the future. So thank you. Have a good one.